Today, we're going to talk about how to SPAC your startup. How do you SPAC IPO your startup? Just like Virgin Galactic or DraftKings. What does it take to do a SPAC? What's the actual process? We look at the 5-step for a SPAC IPO and get advice from some very experienced people.
Just launched the 4 SPAC last week. And in total, I've done 8 public companies I've been on.
Yes, we get the best possible advice to avoid any pitfalls.
What I would caution people on, though, is there are candidly a lot of what I call recovering investment bankers, or maybe less politely, washed up investment bankers in the SPAC business. And
running a public company is not the same as running any other startup, so be careful.
You go to jail longer for white collar crime than murder in this country.
With that, let's get started. This is Raw Startup.
I've done 3 SPAC IPOs, announced 3 transactions, just launched the 4 SPAC last week. And in total, I've done 8 public companies I've been on the board of or been the CEO of. So the first SPAC IPO was February 21st, 2020. We rang the NYSE bell like literally the Friday before the COVID lockdown started, I think. And we announced the transaction July 27th with the #1 U.S. online casino business, a company called Rush Street Interactive. That deal closed towards the end of the year. Second SPAC IPO was in August last year, and we announced a transaction in October with actually a UK-based Apax-owned company called Genius Sports Group. The third SPAC IPO was in November last year, and we just announced a transaction 2 days ago, actually. So it's with a business called IonQ, which is the world's first publicly listed quantum computing company, believe it or not. So it's truly a deep tech company that plays off of my partner's background and mine as a physicist originally.
So all this, 3 SPACs in 1 year, that's just crazy, huh?
Yeah, I've been very busy. I won't kid you. The days are long, and Zoom has been actually my friend.
Yes.
I wouldn't be able to do this, right, if I were flying around the country for a week or two every time one of these is announced, because 1, I would be sick all the time, probably, and 2, there's just not enough hours in the day.
Some things have just become more efficient, right? We raised a big round and it was all done on Zoom. I didn't meet any of them at all. So it's crazy. Anyway, so we're going to get into it now. #1, check the business fundamentals.
Well, it's very much sector specific. What I think most people don't fully appreciate is that a SPAC IPO is really just one of the 3 ways of conducting an IPO. It's a different mechanism. So you have the direct listing option, you have the traditional IPO, which is an S1 filing, and you have the SPAC IPO, which is an S4 filing. All of them are reviewed by the SEC. All of them, once they close, look the same. You're trading under a ticker on the NYSE or the NASDAQ. All of them are subject eventually to Sarbanes-Oxley rules and NYSE or NASDAQ rules on top of the SEC. So, you're going to be compared to your peer group, if you have a peer group, okay? You're going to be trying to court research analysts the same way. And so, people like to ask me what it takes to be public, and I always have to give the same answer, which is, look, what it takes if you're a quantum computing company is very different than if you are an online sportsbook SaaS data provider, and is very different from what it takes to be an online, casino business. And I've done all 3 of those deals. So knowing who you're going to be compared against is really important. Knowing how you're going to be interesting to research analysts is really important. And being clear that you're on a path to go from, kind of stealth and secrecy mode, or at least sharing what information you want when you're private, to being, very much in the limelight is the first thing you have to make sure that you want to do and you're prepared to handle.
Okay, so you're basically saying that a SPAC IPO, when it comes to the barrier of entry, is very similar to any other IPO.
It is. There are pros and cons of each approach. SPACs are faster. Yep. SPACs allow you to get more transparency and more credit for your forecasts, because in an S4, which is technically a reverse merger with my public shell, you're allowed to make forward-looking statements, right? Because it's a merger. But in S1, there's a prohibition on forward-looking statements. And this is the reason why you've seen a lot of innovative earlier stage companies pioneering with the SPAC. So whether it's, space companies, a quantum computing company, a 3D printing company, they've all done SPAC IPOs because you can really talk about the next 5 years, whereas you can't do that in any other IPO mechanism. The third advantage really is that retail investors can participate in a SPAC IPO, whereas they can't in any other mechanism. right? So as soon as you announce a SPAC IPO, anybody in the world can go and buy my existing ticker symbol.
Sure.
Whereas in an S1 IPO or direct listing, it's really just kind of friends of Goldman Sachs or Morgan Stanley that get allocated, and the deal happens and it's already popped, right? So retail really likes that, and it's one of the things that I pride myself on is kind of democratizing the IPO for everybody.
Number 2, get the team and partners ready for the SPAC.
The reality is you're going to be a public company once the deal closes. And the close can take, maybe 3 months from when you announce it. Top quality underwriters, Goldman Sachs, Morgan Stanley predominantly, are increasingly treating this the same as their normal underwriting process from an underwriter diligence perspective. And they're increasingly requiring similar infrastructure. So in the last year, there's been a continual improvement in kind of infrastructure and regulatory requirements driven by the underwriters who want to be ahead of any upcoming SEC rulings. Okay, so my advice really to everybody is you have a year to become Sarbanes-Oxley compliant after you close a SPAC IPO, which is a year longer than you have with any other IPO mechanism because it's a reverse merger. Yeah. You still want to think hard about hiring a CFO who's going to be doing the roadshow even for the SPAC IPO because A, it's good practice, B, some underwriters, namely Morgan Stanley and Goldman Sachs, will probably prefer, if not require it. And I think it will help engender, frankly, some confidence with the long-only top quality investors that you want to attract.
Okay, so hire a CFO, appoint the auditors, and then you go out and meet people, or what happens next?
You hire your CFO, you work on your forecast is the next thing. So, making sure you have numbers that you have haircut enough and reduced enough so that you can live with the guidance long-term is really important, right? So that guidance is going to be out there. It's going to be in the presentation. The presentation will be filed publicly with the SEC. You need to make sure that it's not something that, a 1 quarter or even 1 year later, you're like, whoops, I wish I'd done something more conservative.
Yeah. Right? So I think this is important. You're really building a pitch, but it should not be the same pitch as you pitch a VC. This is a more conservative pitch that has a clear haircut in, so the numbers are predictable, and you're probably going to make them.
No, have to make them, right? Let me sort of give you some examples. The statistics on meeting and beating guidance in the first 4 quarters, the first year of your IPO. If you do that and your stock price is higher at the end of the first year than the IPO price, you're probably always going to be a successful public company. It's like 90% plus chance. If you do the opposite and you miss 1 quarter, like 90% chance you're going to have a hard time kind of forever because people remember this and they remember your philosophical stance. It is absolutely different than a VC pitch. Okay, so let me give you a difference here. If you look at the statistics of venture capitalists and what percentage of their portfolio companies meet or beat plan, it's like 1%. It's like 1% or 10% of people meet or beat.
We're at 99. Let's put it that way.
Yeah, you're lucky. For public companies, it has to be the opposite. Like, you are insane if you put numbers out that you're not going to hit because it will take you like 4 years to recover from like 1 missed quarter in people's popular imagination. This is the US, I'm talking about. My joke for that one, as you know, is you go to jail longer for white collar crime than murder in this country.
So be careful.
Yeah, you got to be careful. Exactly. There's real issues if you do something that, falls foul of one of the rules, for sure.
Number 3, find a SPAC.
I think the best SPAC partnerships really are done where there's a lot of trust in the system and where both the SPAC sponsors, such as myself and the company, have known each other for some time, understand they each have credibility in the space that you're discussing an IPO and can bring a lot to the table, right? You're gonna end up with SPACs and their sponsors being board members, at least 1, if not 2 board seats. You're going to end up with their shareholders being your shareholders. I'm not your right SPAC sponsor if you don't think I know more about the SPAC process than you do. If you've never done it before, and vice versa, I shouldn't be picking a partner company if I don't think they're a fabulous set of assets in the short, medium, and long term, right? So trust is important. If you truly don't know anybody and nobody has approached you, yeah, you can hire a bank to find SPACs, right? You can effectively hire an agent and you can run a process and you can speed date a bunch of SPACs and you'll eventually find one. What I would caution people on, though, is there are candidly a lot of what I call, recovering investment bankers or maybe less politely washed up investment bankers in the SPAC business. And, there's a lot of people learning on the job. Okay. My strong advice to people is you're probably only going to IPO your company once. definitely only once on this piece of the business cycle. And so, you want to go with the best fit you can find, not people who are learning on the job.
Another piece of advice might be that if 9 SPACs say no to you and the 10th says yes, you might not be ready yet.
No, absolutely correct, right? You may be pushing either a price too high, or your business, may not have the fundamentals, you may not have the forecast, or you may not have the infrastructure. So absolutely correct. If you're talking to a SPAC who's got like 4 months left, like they're going to say yes to anything, and that's probably
We'll take it.
Yeah, that's probably not going to go well on the roadshow. Investors will smell blood in the water. It won't be a quality outcome to you.
So now you found the SPAC, but before you move on to the next step, you need some advisors, right?
Even if you have a SPAC that you love, you'll probably want, someone to do a report for your board that says, this is why we think the valuation is fair. This is why we think this process makes sense for you. You have other options. You can stay private. You can wait and do another IPO, an S1 process 12, 18, 24 months later. And this is a recommendation to the board. And ultimately, we think it's a fair deal. You also, of course, need to think about your lawyers. So it's not just M&A advisors. You need to think about your attorneys. And once again, I provide the same consistent advice, which is, you want attorneys that have done this before. Okay. There are league tables of SPAC proficient attorneys, people that have done dozens of deals. You don't want people, and you don't want a partner at a law firm who's, even the law firm has done SPAC deals. If the partner you have has never done one, that's going to be a tough process. Again, you're like learning on the job, and it will be painful for everybody, right? Yeah. Lastly, your accountants, which you mentioned earlier, you want accountants that have done a SPAC IPO also, because, the speed is different for sure than a normal IPO process.
So you need a law firm, you need accountants, you need M&A advisors, and preferably all of them have experience in the SPAC space. Number 4, close the deal with the SPAC.
So step 1, you'll have, a 1 to 5 page letter of intent that will have binding exclusivity and a set of terms that you will want to proceed on that you'll both agree to kind of go into the relationship in the next 60, 90 days together. Once you sign that, you're going to move on to the business combination agreement. And that's, not an 8-page document, but an 800-page document. Okay. The nuance with the SPAC deal is, as you get the business combination agreement proceeding, you're also in parallel going to begin talking to investors who are already owners of the SPAC about whether or not they like this deal, because you want it to be a deal that they're going to vote in favor of down the road. And you might also want to raise some additional capital. So there's something called a PIPE, private investment into public equity. And you can raise a PIPE while the business combination agreement is being negotiated for additional capital. So to give you some examples,
go ahead.
In my first SPAC transaction, we had $230 million in the SPAC trust account. We also raised $160 million of PIPE capital on top. So the total was $390.
Is there a reason for this specific procedure? Is it because you need more money, or why did you do the PIPE too?
Yeah, so partially it's because sometimes you want some secondary, and usually secondary is better received if it comes from a PIPE, because remember, in a PIPE, the investors find out under NDA who the company is that we're merging with. Whereas with the SPAC IPO, those investors are investing in a blank check. They don't know the deal. So if you're gonna cash CEOs and investors out, it's usually a higher bar, right? People want to know that there's going to be value here long term if you start cashing people out. Third SPAC, we had $300 million in the trust. We raised a $350 million PIPE, and that sends a really strong message to the stock market that there are backers like Fidelity who know the company, who have done their diligence, and they're really going to price and underwrite the transaction. And it really sends a strong signal to all the SPAC investors to stay long term and not redeem their money when the shareholder vote happens.
So this is like a poker game where you get your cards, you only have your cards in your hand, and then you put some money on that, but then they show the first 3 cards, and now you can say, okay, I know what this company is, I want to put more chips on the table.
No, that's right. I mean, some of the PIPE investors are often people who also invested in the SPAC IPO. So they're kind of double downing, right, to use your analogy here. So yeah, that's spot on.
Number 5, tell the world and start trading.
Yeah, so what's next is you will simultaneously sign your business combination agreement, and you will sign all of the PIPE subscription agreements, because there's an agreement for every single person in the PIPE. If you raise a PIPE, if you don't, you can skip this step. But fundamentally, once you sign the BCA, the SPAC has signed a material transaction, and it has to immediately announce to the market that it has signed a deal. Okay. And so that is when fundamentally, the world finds out that you've chosen this SPAC and this SPAC has chosen you. And all of a sudden, everybody in the world can buy the ticker symbol of the SPAC. And so, DMYI, for example, that we announced 2 days ago, right now, we haven't closed the transaction yet with the shareholder vote. But if you buy DMYI, it is effectively giving you a position in the underlying, in my case, quantum computing company. And for the next 2 to 3 months, while the SEC is reviewing the documentation you file, that's as close as you can get to owning the end company.
So in theory, these companies that are strictly cash are now trading above cash because they know this company is coming in, right? I guess sometimes you would see them trade under cash, right? That would be a pretty poor indicator.
Absolutely, right? So this is the mark of a good SPAC team, right? I've done 3 deals. My SPAC deals have all traded up, not traded up like a snowflake IPO where it tripled. That to me is the sign of an underpriced deal.
There's still risk.
Yeah, it's traded up, 10%, 15%. The Financial Times always says that my deals are priced fairly, which is true. That's about a fair IPO discount, 10%, 15%, not, 80%. And so, I think,
no.
Yeah, so that's an initial reaction. And then you're into the phase of making sure the transaction closes and getting through the shareholder vote. And so you need to continue marketing. Just like any public company, you have to market the company to new investors, and you have to make sure that you communicate with the market anytime your company has a significant piece of news or a new partnership announcement, customer win, innovation, product launch, etc.
Now the ticker is there. The merger hasn't happened. It takes 3 to 4 months before SEC approves, or what happens?
Yeah, so the next thing you do is you file this S4 merger proxy. And that can happen as fast as, a day after you announce, or even simultaneous, a day anyway, let's say. Or it can take some companies longer, right? It depends how long it takes for you to finish a very long description of the business that has to be, SEC compliant. All the audit has to be in there, description of the audit, description of the forecast, description of how the business transaction came together also has to go into the S4 merger proxy. Then you file that with the SEC, and they start reviewing the document.
And usually total time here is what? How long have yours been? Like 3-4 months, or longer, shorter?
Yeah, about 3 months.
3 months.
I think 2 to 4 months is what you're running. It won't be shorter than 2 months. Hopefully it's not longer than 4 months. Once you get the SEC saying that you are finished, they will declare your proxy effective, is what they say. And then you can convene the shareholder vote.
So now the shareholders vote, and then it merges like within 24 hours, and that's it.
Yeah, so the shareholder vote has a minimum notice period, like any public shareholder vote. And it is the shareholders of the SPAC that are voting on this. And so this is the part where the quality of the deal, how well it's trading, how concentrated the shareholder base is, how well you've communicated to your shareholders in the SPAC will all be vital for making sure you get the vote to happen, right? So there will be usually 20 names that will hold a lot of it, right? So you'll be talking to 20 people, not 200 people, roughly.
And then that's it, right? You have the vote, and there's some time in between there, usually days, and then you're there and you change the ticker. What happens?
No, that's correct. You can close as quickly as 24 hours. Usually the ticker changes overnight. So the market closes at 4 p.m. New York time. If you're on the NYC, it opens again at 9:30 in the morning. So usually the ticker changes overnight. Messaging is really important there. Otherwise, people get confused, right? They wake up in the morning, they're like, wait, but I own DMYT. And like, the ticker is now called RSI because it's Rush Street Interactive in my first SPAC.
So you wake up that morning and check, is the ticker working?
Yeah, absolutely, right? I mean, look, good SPAC sponsors like myself have a great relationship with the NYSE. We've done a lot of deals with them. And, obviously, once you get the ticker to change, you want to schedule your bell ringing also.
Yes.
So that's really an important part of driving exposure. And obviously, it's a beautiful ceremony, the NYSE. I am biased. I've done both NASDAQ and NYSE companies. The NYSE, I think, has definitely a more historic and special process because, of course, it's been operating since George Washington was around, nearly.
Yeah, and you get on stage there and actually do it, right? And I think right. NASDAQ's been trying to compensate with this big banner outside. So basically that's it. You're now a listed company, and you definitely have to act like a listed company. Yes, here are the 5 steps to a SPAC IPO. If you want more content just like this, please make sure you like and subscribe. Thank you very much for watching. Now go build something.